All right, you're a member of Gen Z or Gen Alpha. You're young, you're hungry, you're excited, you're motivated. You want to make a difference in your financial life. You want to make sure that you can control what your financial future looks like. You're ready to put in the work. You want to learn, you're curious, and you want to take the right steps today to get set up on the right foot. The power of compounding over a long period of time. That's what we're going to talk about. Now, this really stems from an awesome question that we received on one of our comments on a video. This comes from Aurora Taylor. Aurora, thank you so much for this amazing question. I got to read this out because it's so cool. I'm an 18-year-old student. I turned this July, so just recently turned 18, determined to build long-term wealth. Love the word determined, by the way, by creating a portfolio of income-generating rental properties. So that's a great goal. Somehow the algorithm must be feeding you some cool information. If that's the case, I'd like to understand where that came from, which is really cool. Maybe your parents already have rental properties. I earn $15 an hour working part-time. So good job. You're going to school, also working part-time, doing all the necessary steps. You're hungry to look after yourself while attending university. And I make an extra $20 to $30 on the weekends for my parents for doing household chores. So that's cool. So number one, shout out to your parents for doing a great job. Shout out to you for being motivated and taking initiative and showing ambition. So big high five. Love this comment and love what you're up to so far. You're going to be going places with this kind of attitude. That's really the right mindset, to be a good banker, infinite banker specifically, but also to be able to set the rules of how you want to move forward in life. So well done. My 10-year-old sister, she earns the same amount, that being for the chores with the household stuff. And we've both been consistent over the last 5 years, each with about $7,000 set aside. That's amazing. Congratulations. High five. By the way, $7,000 over about 5 years. That means on average, you guys are saving about $1,400 a year consistently. And you've already demonstrated that over a long period of time, which means there's a high probability and likelihood it'd be easy in a world where you were just getting paid by your parents, entering a world where now you can also earn money part-time in other work, that you could probably increase that with the right behaviors, and also that you could consistently be able to do that probably for base premium on a policy, which I'll talk about in a minute. I recently came across the infinite banking concept through your videos. Thank you for watching, by the way. Richard, I'm motivated to start as early as possible. Love that. Word motivated and just starting early. And as part of Gen Z or Gen Alpha, we don't want to follow the average financial path. We want to become financially literate. Well, I think you're already on the right path, Aurora, just based on your comment. Strategically grow our assets and build a steady cash flow from a young age. Could you walk us through how Canadians our age can start applying IBC principles now and set ourselves up for sustainable generational wealth? So, Aurora, the reality is you're already doing a lot of the right elements. At a young age, you've already demonstrated the ability to save and save consistently, and that there's a value and importance in saving and having something that you own and control. So that's really important. You're already talking about things like being strategic, long-term thinking, generational wealth. It's not particularly common for 18-year-olds to be talking about generational wealth. A lot of 18-year-olds are wondering, or 19-year-olds and 20-year-olds are wondering, where are my colleagues, my friends, and my drinking buddies going to which bar this weekend, or some variation of that, right? So you're already positioning yourself for the right mindset and the right elements. So you're actually doing the things you need to be doing right now. Now, to add IBC into the mix, there's some ways that we could look at doing that, or how you could consider. Obviously, you work with a coach one-on-one to do that, customize everything. But I wanted to use your comment as an example, maybe for a bigger audience. So not just Canadians, but Americans as well. And just looking at, okay, what would the impact of this be? So I thought I would put together an example and walk through, hey, what if we just did the minimum? What if we added some flexible premium along the way? How does that change over time, and get that long-term view of what that can look like? Now, I'm not going to go through this to an exhaustive degree because we could really go into the weeds on this, but I wanted to give you an example with such a great, well-written question to give you a really good response that also provides something maybe more tactile for you to really start to put a vision together of how you might implement this in your life. I want to also, before I jump into the example, I want to speak a little bit about the real estate component. So you mentioned building and generating rental properties, which I think is amazing. I do have some experience there, and I, like yourself, I actually started some of these things when I was very young. I had been involved in rental real estate, our first rental property with my family when I was about 11, 12 years old. We had one for about 6 years. We sold it pretty much right before I turned 18. I had an amount of money that came out of that. I reloaded it into the next rental property. I did that in joint with my parents. 3 years later, we sold that one. I got my first $15,000 check from a lawyer's office, and I thought, wow, there really is something to this real estate deal. And then in that same time frame, we would already acquired another one, and I was on the process. I then purchased my own first property for myself, and so a lot of activity in the real estate game happened for me very early on, right around your time frame. The difference, of course, is that we've had a lot of inflation since I did that when I was your age, and it may not be quite as easy to get into the real estate market. Now, in general, inflation affects income and other assets, but have they kept balance? I think a lot of people would say that they haven't. So getting into the market, depending on where you live in Canada, could be more of an issue. Certainly from an affordability index, the province of Alberta generally tends to lean to better affordability, even though there's been a lot of rapid increase there as well, a lot of in-migration to that area. But you can still get access to a property for 5% down, and there could be some advantages to that. And you can also tag team things with your parents if they're, they've already set you on a right path, right foundation. Perhaps this is something they would also be interested in doing with you in a joint venture model, and you guys could learn and grow together. For me, when I was young, I bought my first property 5% down. I had roommates. I had them pay most of my bills. So I think 1, 2, 3, 4, probably about 5 or even maybe 6 houses that I accumulated over the next decade. All of them I ended up buying and moving into, and then I would keep the previous one to some degree, or there was some creative elements that took place there with some real estate partners. But ultimately, I was able to keep moving up and acquiring another asset. But I always had someone else fundamentally paying my bills. Now, that being said, you don't always want to have to live and share a place with roommates or whatever. If you're getting into relationships, I mean, it can complicate things a little bit. But I was pretty focused on the financial path and how I wanted to maintain as much of my cash flow as possible while still being able to try to create and build some assets. So I understand some of the things you've identified because I've walked a similar path. It just was 25 years ago. So a lot's happened in a quarter century. It sounds really strange to say that out loud, by the way. But the mindset that you're demonstrating is not unlike one that I had learned from my folks and being a good saver and always setting money aside. So I hope that helps. A couple of things I would recommend for you in this real estate area before I get into the other example. Focus on getting that first property. Don't try to buy the investment property. Get the first one for you. You have to learn about the process, looking at properties, the buying properties, contracts, applying for a mortgage, getting approved, taking possession, unexpected expenses that come up, meeting with a lawyer, legal bills. All of these things is a learning process that is a really important process. And if you plan on doing more of it, you want to go through those steps as soon as you can. See if your parents will jump in with you, work out a partnership arrangement, make sure there's something in it for them, that sort of thing. Try to find partners to help you do this so that you can be able to accomplish acquiring, but recognize that you also now have to manage things very effectively. All right. I would also recommend that you join some networks or some meetup groups about real estate in your local area. You can look at reviews. You can talk to a couple people about which ones they would recommend. Sometimes you go to them and people are trying to sell their deals or their investment projects or what have you. But it's also a really great place to network because most of those people were like you at one time. And they're going to be proud and happy to see that a young person like yourself is there, taking initiative and getting involved in things like real estate investment. And you'd be amazed at what kind of mentors you might find by going to those sessions. There's an old adage or expression that your net worth is a direct reflection on your network. So if you build your network, you therefore by default have a higher probability of building your net worth. So I'd encourage you to take that into consideration. Okay, so with that in mind, let's jump in and look at this example that I put together. I'm just going to share my screen here. Let's see. All right, perfect. So what we'll see on the screen here is a spreadsheet. I'm going to try and make this a little bit bigger if I can, so it goes full screen. Let's see how effective we can be there. We're going to go Control-Shift-F1, I think is the deal. There we go. Magic. It's magic. All right, so this is an example of an 18-year-old policy I put together using some numbers kind of based on your example, just as a baseline. I wanted to target something in about the $5,000 level. So that's kind of what I solved for. And coincidentally, I was looking to get things in the range where the base premium was around the number that you provided on that kind of $30 a week that you've been consistently doing for a long time frame, because it's already been consistent and you've already been very adept at saving that. So that would be a rational way of looking. Hey, I know that at minimum, I should be able to do this on a pretty consistent basis. So why don't we look at that towards a base premium? So you can see over here, there's an area that says base premiums only. So I'm going to look at this. It's the same example, the same quote unquote policy, but what we're looking at is variations of it. So variation number one, example number one, is what we call the base. What if all we did is the bare minimum, the base premium? We never put any flexible premium, also known as paid up addition, rider. It goes by a various number of terminology depending on the insurance carrier. But what if we only did the bare minimum base premium? We just had a basic policy, and again, it came with some death benefit. What would that look like? So in this case, I'm using a male here, and the reason is that whether you're male or female, well, the males are going to have generally get less coverage for the same amount of money. So if we replace this with a female, it could be the same amount of money going in, but there's going to be more coverage created, and it's going to be very similar. Okay, so that's why I chose a male in this scenario. And here's another key element that I would identify as really important. In this scenario, I have a term rider on here, which we have for several reasons. I like to say that we hire term insurance as a someone to work for us, as a thing to work for us, for three primary reasons. All right, we're going to hire it to do three jobs. Job number one is to create the right proper coverage for you for your scenario. Now, in this case, 100,000 whole life and 500,000 of term insurance. That's $600,000 of coverage. Most 18-year-olds do not need $600,000 of coverage. And in fact, it might actually be difficult to even get that approved by a life insurance company, depending on your income scenario. All right, that's where a coach has got to go to work to figure out how they can present and justify that amount of death benefit to the life company so that they'll agree to do it. Okay, but in my example, I'm not going to get into the weeds on that too much. I'm just kind of giving you a preview, I guess. The next thing that we're hiring it to do is job number two is to create convertibility. It's an option to lock in health coverage, your current health status today, lock it in for an extended period of time so that if you wanted to grow and increase the size of your system, you already have the insurance approved and they can't deny you the ability to convert it. That is a very, very powerful scenario. So in this scenario, as an 18-year-old, someone in their, young 20s, 18 to 20s, locking in at a very, very inexpensive, or you could say cheap price point using the term insurance, we are locking in a bunch of future tomorrows. Now, in this scenario, I would always recommend for a younger person that we lock in a longer time frame term rider, probably 20 years at the bare minimum. Sometimes you can get a term for 30 years, depending on the company. In this case, I'm looking at one that does a term insurance or a term rider to age 65. So we're literally fixing and locking in a price point all the way to age 65. That creates a ton of time frame for you to be able to make decisions about your future. So as your income goes up, you come out of university, now you can convert portions or all of that term insurance, perhaps over a number of iterations, into new policies as you go and you build your asset base, your net worth, and your system. So really, really powerful strategically to rent a little bit of that insurance benefit to create a long-term possibility to grow the system that you want. Because you already qualified for the term insurance, the ability to convert is there in your future. It's a very powerful thing. Again, you want to be working with the right company to do that. Most term insurance is convertible, but not every company has the right products or tools to convert it into. So just so you know. Now there's a third job. I mentioned three jobs. Job number three, and again, this varies by life company, etc. But sometimes we can utilize the term insurance to also, or a portion of it, let's say a portion of it, to help create almost a lever that allows us to increase the premium that we can put into a policy. Again, this varies by company. There's designs can kind of be all over the map, but it is a possibility to help us increase some of the flexible premium available to you. So in that scenario, I've used that here, and I won't go into the weeds on that either. But anyway, we're hiring that term insurance to do basically three jobs. So it's an important feature as part of the design. So we're setting you up for long-term thinking to go with your long-term vision, because Nelson says you've got to learn how to think long range. That's rule number one. So there you go. So here we've got base premiums only and this 1568. Well, if we take the $30 a week and we times that by 52 weeks, all right, 52 times $30 a week, that works out to $1,560. $1,560. Well, that's pretty much right on target with this number. I'm pretty sure you could figure out where to get the other $9 from at the end of the year. Okay. So that almost works out perfectly. Now, this particular policy I'm showing, I will show in a moment, the maximum amount of premium we can put in is $5,000. So 1568 is the minimum, 5,000 is the maximum, but I'm going to do this in phases. So first, we're just going to assess what is the base premium doing. So you can see I've got that for the first 10 years. I've kind of blocked off the first 10. We're going to talk about that at different stages. Here we can see the cash value. This is the cash value in this particular contract each year at the end of the year after you've received a dividend. Okay. I'm not showing the dividends here just because it's not relevant to the conversation. And I'm just going to scroll all the way down and I'm going to make a note. At age 65 here, I've highlighted the premium in red because it's changed because we've had a drop. So we go from 1560 and it drops down to just the whole life portion because we're going to get rid of the term insurance. It ends at age 65. So I just wanted to highlight that so the premium eventually shifts because the term insurance changes as well. Now, if it had a different kind of term insurance, that premium could go up if we renewed a term rider. Again, not to get into the weeds and the specifics there, but just preparing everybody for that. And then over here, we can see that cash value. Now, just out of curiosity, if you look here from age 65 to age 66, you can see there's an increase in this cash value. Oops. That increase is approximately $12,000. So at age 66, you put in $1,228 and the policy increased in that same year to over $12,000. So did we get 10 times the growth on our premium deposit, premium going in? The answer is not exactly. You could isolate that one year and say somewhat that's what it looks like, but it's not the case. It's the impact of all the premiums before it, all that capitalization and all that compound feature over time. Okay. So I'm going to scroll down to age 100. Now at age 100, this particular contract, again, it assumes that dividends have been paid throughout every single year. We have a cash value of $1,172,000. Well, I've summarized the total amount of premiums that went in. So 117,000 went in over an entire lifespan of 82 years. 117,000 created 1,172,000. So just on its own, very basic policy, very simple, this is like plain vanilla style policy happening here. Still produces a really good end result, but it took a long time to get there. Yes, you would have been able to borrow and access capital in the early years, just maybe not as much as we could if we had maybe added some elements to the policy. So there you go. That's what we call the baseline example. All right. So what I want to look at next, I'm going to go ahead and bring up example 2. In example 2, I'm simply going to show what if we were able to get the maximum amount of premium in just in the very first year, 1 year only. Everything else is exactly the same. We haven't changed anything else. We just made that minimum premium, that $30 a week from doing chores, and we've committed that for our life to help build something that's long-term and sustainable. And in the first year, because we've already saved up some money, you indicated you already had $7,000. Great. Well, we could get a chunk of that existing savings moved into a policy in the very first year. What would that look like? Well, in this scenario, we can only do 5,000 because we can't put more than 5 in the way that this, the contract won't allow it, but you could put the extra 2,000 you have saved in year 2 as an example. I'm not going to reflect that here. So let's follow that down. So obviously we have a higher starting cash value right away. We went from 746 to now 4,100. You can see the policy increasing, etc. And if I scroll down, I'm just going to go right down to the very, very end. We now have almost just shy of $1.4 million. So the increase between this number and this number is actually a pretty substantial increase. It's like $226,000 of extra capital, but you only put in about an extra $3,400. So 1 year you put in $3,400. The net result at the end of, at age 100 is essentially $226,000 more capital. Or another way of looking at it is, hey, if I take out the money that I put in extra, I have a net increase of $222,000. So that would be over that it's a long time frame. It's 82 years. That's the power of compounding. The longer we have to put it to work, the more powerful it can become. So that one decision in year one to take an already saved resource of money, $7,000, take a chunk of it and make sure it gets put into a powerful machine, a system that allows it to continually grow for the rest of your life. The impact of that one decision could create an extra $222,000 compared to just doing the bare minimum. So that's kind of what we're looking at there. So that's example number two. So let's go one step further. We'll go to example three. Now, example three is, well, if it was pretty good to just put the 5,000 in one time, I'm going to school, I'm going to university, I've got this part-time job. In the summers, I'm probably going to get more hours in. And maybe I'm still living at home, maybe I'm able to reduce my expenses, maybe I have roommates. Hey, if I could commit getting that 5,000 in every year for the next 10 years, what would that look like? So that's this example here. So I'm showing the premium funding is 5,000 for the first 10 years, then going back to paying the minimum. And you can kind of see some of the impact here. Obviously, the cash values grow really, really well. By the time we get out to the 10th year, we have a cash value asset that's about $56,000. Now, with this particular company, you could borrow 90% of that number. Whatever this cash value is, again, we're looking at end of year values, you could borrow 90%. So, borrowing throughout the year, of course, you can do that. Just might be a very slightly different number. Okay. When I get to, year 10 to year 11, notice I've got a highlighted example here where the cash value is $60,750. Well, if you subtract this value from the year above, we had an increase of $4,093. That's a pretty decent increase. And in that year, we only put in $1,568. So $1,570 goes in. And in that year 11, we had a $4,000 increase. That's a pretty good impact on the proposition of a dollar. So when you put a dollar now into the machine, in this case, you're getting 3.5 times that dollar of increase inside of the tool because it's now been more capitalized. It's operating more efficiently. It's got more power underneath its belt. That's the magic of having this working for you over a long time frame. So there you go. Now, again, just to keep the video a little bit short, I'm going to scroll all the way down to age 100 because it's a good endpoint. Here now we've got a value that's $2.9 million, 2.95, and compare that to the previous example of 1.4, we have a very substantial increase on the two policies. And if we look at the baseline example, when we go back to the baseline version, I'm actually just going to delete this box over here. The baseline version, we put in, again, 116,000. In this new version, you put in 151,000. So you've added, because you paid that $5,000 for 10 additional years. So 34 grand more money went in over the first 10 years, $34,000 over the first 10 years, more saved capital. The result of that is a substantial increase versus the baseline. The increase is a net of $1.7 million. So you traded $34,000 over 10 years of your life to create 1.7 more potential value. It's a lot that we're doing here. Okay, so last example, again, I know I'm doing this very quick, but I just want to give some flavor on how this works. This last example is, what if we continued to contribute the entire amount, the maximum amount, but we did that all the way for the entire life of the policy. So you see, I got 5,000 going down each year. Then we have a drop because we got rid of the term insurance. We continue putting the maximum in. The end result is this particular policy, that's a Canadian policy, so it goes to age 100. It doesn't go to 121 like some of our American counterparts. The result is we put in just under $400,000 over an entire lifespan, an average of about $4,900 a year. Well, that's a lot more. We put in $281,000 more than in the baseline example, but we now have a pile of capital in cash value represented as $5.3 million. So the impact or the net gain is 3.8 million when we subtract out all the extra premiums we put in. Pretty big difference between what we're looking at. So this is the power of that compounding over time. And I think, most people would agree, hey, I would trade $281,000 over 82 years to create $5.3 million. I don't think there's too many people who would say no to that proposition. This is the thing that matters. It's not the growth of the policy. It's what were you doing with the policy while it was growing. So let's zone in a little bit more here and use an example. I'm going to pick, I'm going to work with just example 3 because it's already highlighted kind of right in the center of the screen. So you can see each year this is building. Well, at the end of year 3, what if you needed to borrow to go and buy a used car and you were able to borrow $10,000 out of here, buy a car for your parents or something like that. Or maybe you were building and saving up for that down payment on that first piece of property. You were going to tag team a down payment with your parents. Maybe you wait until year 4, you can borrow $15,000 roughly. Your parents contribute $15,000, let's say, to the deal. Or maybe they do a little bit more depending on the property. You each have 30 into the deal. Well, 5% down, that could be potentially a $515,000 property. Well, in the city of Toronto, that might not get you very much, maybe a cardboard box on the street. But in Edmonton, that could get you a 4-bedroom house, maybe 2 bedrooms upstairs with a 2-bedroom basement suite down below that you can now rent out and cover your expenses. So that could be a pretty cool option. So this is where you start to see putting this into work and implementation. So what are the things you're going to need over the next 4 to 5 years? How are you moving money you already have, moving cash flow that you're already accustomed to saving, applying it into a machine that allows you a multitude of options, and then putting it to work in different areas of your life. So there you go. There's kind of a rundown on how you might actually go about making this functional in your own life and putting it into work, and an example of what it could look like. It's not exhaustive. We're not going through all the details, but it's enough to have a little bit of context, especially at a young age, with an amazing question from a great new viewer, looking at implementing something very powerful that could drastically change the trajectory of your financial life and create way more control, way more consistency, way more peace of mind for someone that's got a long-term vision. So thanks again for an amazing question. I hope you got value out of this. Let me know what kind of comments you have about this particular example. And make sure, if you haven't already, connect and book a time with one of our coaches. We should have a link down below to where you can do that. And one last thing I will mention is we always recommend, because of the long-term mindset and thinking of this, especially if we're looking at families, and for this young individual at age 18 is already projecting next generations of their family, this book right here, Don't Spread the Wealth, is going to be a really key add-on to coincide and tag team with Nelson's book of Becoming Your Own Banker, to have those things available so you can start planning family banking meetings. And even though you might be the scenario where you don't have your own children or grandchildren yet, but you have parents, perhaps you can be the entry point to get them thinking about that. Even if the conversations you're having aren't about the infinite banking concept, that's fine. But you could start having and using the guides and the tools that we have in here to start having really regular and powerful conversations about money in general and legacy in general. It doesn't have to be dedicated to family banking. It could be dedicated to family financial improvement, if that's the case. But those conversations can be instrumental and make a drastic impact on everyone's lives over the next 10, 20, 30, 40, 50 years. Okay. Thank you so much. And make sure you check out, boom, this next video.